Every retiree, frankly, anyone who's preparing for retirement has to have an investment plan to make sure that their money keeps up with inflation and they can have financial security for the rest of their life. So if you're lucky enough to be one of those people that has saved throughout their career and has some money set aside for retirement, today's video is for you. We're going to talk about what is working right now in the investment world, taking a big picture view of the different investment opportunities and things that are available, and then bringing it into context for somebody who's about to retire or somebody who is retired to help you think about maybe changes or possibly just things to consider as part of your investment retirement plan. So sit back and let's get right into this video. So if you're new to the channel, you probably don't know that investment videos are not something that I typically focus on. Normally, when I make content for my YouTube channel, I make content looking at the big picture, the entire retirement plan. And there's things like, when do I claim Social Security? How do I minimize taxes over my retirement? How do I maximize my income? And frankly, how do I invest is a part of that process. It is something that obviously you have to consider and think about, but I usually don't make videos focused on that. Well, right now, there's just so much chatter about the markets. Are we in a bubble? What's going to happen with AI in the market? And so more recently, I've been making more of these investment videos. And to tell you the truth, I really enjoy making investment videos. As an investment advisor, that's what I do for a living is give investment advice. So with that being said, this video is not investment advice. I'm talking about principles here, general overview of concepts. I do want to make things kind of helpful and maybe help you think about how you can apply these things to your own retirement situation. But I must say, this is not investment advice. This is very educational in purpose and what I'm trying to do here. So without any further ado, I'm going to pull up my screen here and let's take a look at some charts, because there's a couple of things that are happening right now in the markets that I think are extremely interesting, especially for someone about to retire or who is retired. So the first chart that I want to go over, what you see on the screen is a historical analysis of what usually happens in the stock market. And here I'm talking about the S&P 500, the largest publicly traded companies in the United States. So companies that anybody can buy shares in. You can own a piece of these companies, participate in the losses. I meant to say participate in the gains and the losses. Well, I think it's kind of interesting. Every single one of us, we're always thinking about, is there any piece of information that I can kind of grab onto that's going to help me make better informed decisions about what's going to happen in the future? And frankly, history never repeats, but it rhymes. You've heard that old adage. And so I think in the spirit of that, this chart is pretty interesting. So what we're looking at on the chart is a comparison of what the typical performance of the S&P 500 is in a year where January's performance is positive or negative. You know, the takeaway from this is that generally, if the stock market has a positive January, on average, the market is positive for the rest of the year. And the inverse is also true. If the market is negative, the performance is negative in the S&P 500 over the month of January, usually the rest of the year also struggles. Now, are there exceptions to that rule? Well, obviously, yes. And looking at the historical analysis, is this going to give us a guarantee of what will happen in the future? Of course not. But if nothing else, it's kind of interesting. And maybe it kind of tilts the scales to maybe give us an idea of maybe what we could expect, right? And so on the chart, what we're looking at is performance over the month of January in the black line. So you can see right here that performance over the month of January was about 1.74%. Now, in the blue line, this is showing us historically what has happened on average over the rest of the year when January was positive. And in this kind of light green here, that's showing us what typically happens in the stock market over the rest of the year if January is negative. So if nothing else, this is maybe one indicator to kind of tilt the scales towards, you know, it's maybe the expectation of having a positive year in the stock market is not foolish. It's not foolhardy. And, you know, if we look at performance over the last couple of years, right, we've had really good performance. We had a strong year last year. Year before 2024 was a great stock market year. And there's always the question of how much longer can this go on? Are we in a bubble of that sort of thing? I think I need to remind everybody that we actually went through a pretty nasty bear market in 2022. And so it's not that long ago that we had a really difficult year in the stock market, not to mention also the bond market. So it's not like the market has been going straight up for the last 10 years without any interruptions. We've definitely had some pullbacks, not to mention the major pullback that we had in April of last year, right? And so kind of interesting here. Now, I want to take a closer look at the US stock market before I move on to some other topics, because I think if we look at more than just the S&P 500, if we look under the hood at kind of what that's made up of and maybe what's happening in the market right now, if nothing else, the information is interesting. And I think in my mind, it gives me a little bit more of a positive expectations for the rest of the year. So let's look at the next chart. So here on this chart, we're comparing the performance of the US stock market for just 2026. So far, here we are in the middle of February, and we have three lines here. The green line represents the Dow Jones Industrial Average. The blue line is the S&P 500, and the black line is the NASDAQ Composite Index. Now, each of these market indices are tracking broadly the US stock market, but they have a slightly different composition. I would say probably the most well-diversified, or no, I don't even know if I would say that. I would say the most commonly used index that people use to track the US stock market is the S&P 500, right? But kind of interesting, because each of these indices has different compositions, and what I mean by that is a heavier weighting towards technology companies, like in the NASDAQ, versus a higher weighting to consumer staples and industrials and materials, like the Dow Jones Industrial Average compared to the S&P 500. So you can see that the performance, the disparity between these three indices so far this year is very interesting. It's quite a large dispersion. So right now, year to date, the Dow Jones is up by about 4.5% compared to the NASDAQ, which is basically broken even. You haven't made anything or lost anything, assuming you own since the beginning of the year. And the S&P is kind of right in the middle. And so kind of interesting when you own a basket of, a diversified basket of stocks, just because depending on what you own, this is either looking out to be a really good year so far or just kind of a mediocre year. So let's look even further under the hood and see how different sectors of the US market are performing right now. Okay, here we go. So on this chart, we're looking at the performance still year to date of 2026 of each of the sectors of the S&P 500. And you can see here, we have a huge dispersion between the different areas of the market. So over on the left-hand side of the screen, you can see this 20.5% return. This is for the energy sector. So think of big companies like, ExxonMobil, the one at top of mind for me, or Chevron, big publicly traded energy companies. And kind of interesting, we haven't seen this in a very long time. And in fact, with energy stocks generally, they've kind of been flat for such a long time. But you can see that so far this year, they are doing very, very well, up over 20%. Flipping all the way to the other side of consumer discretionary, think of the products that, companies that sell products that you don't need, right? That are kind of luxury items, perhaps. This is consumer discretionary. And you can see that for the year, that part of the market is down by about 3.3%. And then everything in between. So kind of interesting here. So when people talk about the US stock market, often they'll refer to this as a rotation. So maybe the entire market is generally positive, but basically we're having a switch of what is doing well and what is doing poorly. So, for many years, technology companies have been doing by far the best compared to everything else. And so here you can see that technology companies are slightly negative for the year, while other parts of the market are positive. So you have this rotation. So overall, maybe the market is kind of just going up a little bit. It's not crashing, but under the hood, depending on kind of how you're concentrated by sector, you could be having a great year so far or a very poor year so far. But overall, in my opinion, I think this is actually a great thing. Personally, I get a little bit nervous if there's a part of the market that just keeps going up and up and up and up without any pullback. Because with investing, something that we always have to remember is that markets go up, but they also go down. And so if you just constantly have positive returns and there's never any downturn, you can kind of forget that. Making money is the objective, right? Overcoming inflation, creating and preserving your financial security, that's the objective here, right? With investing for most people. But the issue with owning stocks that just keep going up all the time forever without any pullbacks is that we can start to erroneously believe that it'll go on forever. And I don't think that's realistic. The market goes up and the market goes down. And so every now and then having a part of your portfolio not do as well is just a nice sanity check and reminder, okay, I need to be diversified. I can't just have all of my money, in 5 hot tech stocks. It makes sense to own other things that have not done as well because, like we're seeing this year, sometimes they have their moment in the sun and they do well. And as a retiree trying to manage risk, you want to be well diversified so that if the market goes down, you're not super concentrated in the one area that's really getting hurt. Anyway, just kind of interesting overall situation with the stock market so far in 2026. So I want to go on and talk about the investment universe more broadly. And so on the chart right now, what I'm showing is a historical analysis of the US market versus international markets. So this is broadly speaking international markets looking at the big stock markets overseas, like throughout Western Europe, as well as Canada, Japan, Australia, but then also China, India, Mexico, South America, right? There's a lot of areas of the world where you can invest as a US investor, which is actually pretty awesome. We as US investors, we can participate participate in not only the success and growth of companies in our own country, but you can participate and benefit from the growth and the progress that happens all around the world. Honestly, I think it's great. So on the chart, what you can see is anywhere where the chart is blue, kind of above the line, these are years where international stock markets outperformed US stock markets. And where you see this black here, these are years where international markets underperformed the US stock market. So you can see that back in the early 2000s, there was a good little run here where the international stock market, I should say, was really doing a lot better than the US market. And you can see there's kind of this point right here where things flip, and not on a permanent basis, but they flipped for a long time. And that's right with the financial crisis. After the financial crisis, all stock markets, US and international markets, everything tanked, and then everything went back up. However, there was a huge disparity between international markets and US markets. Basically, it's been something like a 15-year period of time where not every year, obviously, as you can tell from the chart, but in most years, US market has just completely smoked international markets. So for most US investors who already have an inclination to invest most of their money in the United States, you've been well served by that. And so I think it's very important to look at this chart because we tend to invest based on what has recently done really well. For the last 15 years, let's say you're about to retire or you've recently retired, most of your, recent investment experience has been one where, hey, if I just own the S&P 500 or if I own big technology companies in the United States, that's how I succeed. That's what's worked really well for me. And so you're likely to continue doing that. And in my experience looking at retirees' investment portfolios, by far, most people have most of their money, if not all of it, invested in the United States. Sometimes I'll talk to somebody and they'll say, wow, I'm really well diversified. See, I've got money in the S&P, in the Dow, and in NASDAQ stocks. And, from that previous chart you saw, there was, disparity in their performance, but there's a ton of overlap. I would say that is not a very diversified portfolio. You just essentially own the US market. And to be candid, like I said, for the last 15 years, that has truly been the winning strategy. If we were to zoom back on this chart, and I won't pull it up for you, there's another great chart I like to look at, which is essentially this same historical analysis going back through the 1970s. And you can see that there's this ebb and flow. There's 5 or 6 years where international markets do better, and then the US market does better. And it kind of ebbs and flows, almost like a double helix, kind of up and down, changing places of what's doing better. This is just looking at the last 20 years or so. And I like to show this because it's a good reminder that just because something has done really well for the last 15 years doesn't mean that it will continue to do that well. And historically, there's been this ebb and flow relationship between US and international markets. This is all to say, the prudent way to internalize and apply this information as somebody who's about to retire or in retirement is that for the growth portion of your portfolio, it makes sense to be well diversified, which in my opinion includes investing overseas, owning a share of the best international companies, real global winners around the world. So kind of interesting. Maybe you like this chart. Let me know what you think. But let's keep going here. So here's just a very clean chart so far in 2026. I made a video a few weeks back looking at performance over 2025. And the takeaway was, well, if we just go back to this chart, you can see that in 2025, this was the first year in a long time where international markets really outperformed the US markets. So looking so far this year, kind of interesting. So far this year, this is pretty incredible. The emerging markets, which is, let's think of like China, India, Mexico, Brazil. In fact, we'll probably look at a chart here in a minute, gives a more granular breakdown. But the developing world and then developed international, this is like, think of Western Europe, England, Japan, Canada. And then we're looking at Europe just by itself compared with the United States. Basically, anything overseas, frankly, so far this year is doing triple or quadruple or 5 times better than the US stock market. Pretty incredible so far. Will this persist through the end of the year? Obviously, your guess is as good as mine, but looking at this previous chart, it seems that if we use this as a little bit of a barometer, or maybe try to glean some lessons from this, it seems that the outperformance or underperformance tends to trend for a few years at a time. So is this recent outperformance going to be just like one of these blips, right? Where international markets outperformed? Or is it going to be something more like this where the outperformance persisted for several years? I don't know. But again, the whole idea of diversification is admitting you don't know what's going to happen in the future and spreading your bets out. So kind of interesting. And as a US investor, you may not be aware of just how well international stock markets are performing at the moment. So kind of interesting to look at. Okay, now looking beyond just the stock market, US and international stock markets, I always like to step back even further and look at what are all of the available things that somebody could invest in and see how things are doing. So on this chart, we're looking at asset class performance for different areas of the global investment universe, which includes obviously US and international stock markets. It includes the bond market, but then also kind of maybe let's call it non-traditional or more speculative things that you could own, like precious metals like gold or digital currencies like Bitcoin. Now, I call these a little more alternative or speculative in nature because when you own gold, you're really just betting that somebody else is going to pay more for it in the future than you paid for it today. It doesn't pay a dividend. It doesn't have any cash flow. And the same thing, frankly, is the case with Bitcoin. And so they're more speculative in this sense. I'm not saying it's not a reason to own some of it, but it does make it very different from owning something like shares of ExxonMobil or owning a piece of, rental real estate or owning a bond where you're getting a guaranteed contractual payment from the person you've lent the money to. But interesting, nonetheless, looking at performance across the global investment universe. Here at the left-hand side, we have gold again. Now, gold, the price of gold just shot up by like 60% last year, and already year to date, as of February 10th is when I'm pulling this data from, gold is up another almost 18% for the year. Again, international stock markets, emerging markets, and actually, interestingly enough, smaller US companies doing well, medium-sized US companies doing well, international stock market, real estate having a better year than the broad US stock market. So for the diversified investor, right now, there's a lot of areas of the world where there's a lot of opportunity. On the flip side, with the caveat, the main outlier caveat being Bitcoin, which had a very difficult year last year, and so far this year is also struggling down, more than gold is up. So kind of interesting overall. So with all this being said, looking at US and international markets, what are maybe some takeaways for somebody who's about to retire or who's in retirement? I think the number one takeaway right now is that, well, number one, in the headlines, there is always, I'd call it salacious content, trying to make you feel, that the world is about to come to an end and the stock market's going to crash and you're going to lose everything. And I think from some of the information we looked at today, there's actually some reasons to be positive about the future, right? We've had a positive January, which tends, at least if we look historically, has leaned towards having a positive rest of the year in the stock market. Not a guarantee, but it is a positive data point. There's also what I would describe as a healthy rotation from areas of the stock market that have done really well for many years. And now we have kind of a passing off of the baton, if you will, to other areas of the economy that are now starting to go up and, at least from a stock market perspective, are performing better. For a long-term overall diversified investor, this is actually a positive thing. It is not a good idea, or it's, like I said, I think it's unhealthy for one area of the stock market to just dominate forever because it can make us forget that what goes up can go down, and that can cause us to be maybe more aggressive with our investing approach, less diversified than we really should be. Another point is the old point of diversification. There are many investment opportunities around the world, and last year and so far this year, you've been well served by having a globally diversified portfolio. I think it's a good idea to always have your money spread out among a lot of different things so that no matter what's happening in the world, you at least have the chance to participate in the growth and innovation that's happening wherever it may happen on the planet. So as a retiree, you have the best chance of maintaining or increasing your financial security over the long run. We didn't talk about other types of investments like bonds today, but remember, those are absolutely part of a diversified portfolio. And especially if you're about to retire or early in retirement, I didn't talk about it in this video, but setting aside several years of planned distributions from your portfolio, setting that aside in something very conservative, cash, short-term government bonds, in order to maintain and protect your cash flow in the event that you have a big stock market crash early on, is what I think every retiree needs to take very, very seriously. So, like I said, this is not investment advice. This is just educational. And frankly, I'm a little bit just rolling off the cuff. I don't have this video scripted or anything. This is just me riffing on things that I find very interesting and that I think are very relevant for retirees today. So if you'd like some help looking at your investment portfolio, if you're concerned that maybe you're not positioned the way that you could be or should be, that's something I'd be happy to chat with you about. You can click the link in the description to schedule a free consultation with me, and I'd be happy to give you my 2 cents about what you have going on. So with all that in mind, I really hope you have a great week, and I will catch you in the next video.